Welcome to the Investors Corner. This week, again, sponsored by Mortgage Tribe. Give me a natty hoodie as well. So, my favourite brand at the moment. Tom's joining us from Mortgage Tribe to talk buy-to-let mortgages today, Andy. Mortgages have been the hot topic of conversation because they just keep going below 4, above 4, below 4, above 4, below. No one can quite decide whether we have below 4% rates or above 4% rates.
Bit of uncertainty, isn't there?
Well, it seems to be certain uncertainty.
Yeah,
it's a good way of putting it.
If you get the even week, it's slightly higher, and if you get the odd week, it's slightly lower, depending on whether it's which bank A or bank B, really, Tom. So what is the truth behind it?
Well, it's literally that, because I send out like a weekly email on a Monday updating everyone what the interest rates are, and it is literally 1 week, I can get you a sub 4% rate, and next week it's not. But it's I try and avoid any sort of doom and gloom with that. A lot of it is the lenders trying to keep their service levels at a good sort of time frame, because when we saw, say, Santander come out, this is obviously on residential, with the first sort of sub 4% rate for about, I think it's the best part of a year, it's at least 6 months. That seemed like, oh yeah, this is great, amazing news, but they got absolutely inundated with, those would have gone like hotcakes. So if they're dealing with so many applications, there's only so much time they can put into that, and what they don't want is just a huge backlog of applications. So what they then did the next week was like, I was now 4.1, for example. But so that can be seen psychologically as, oh god, that's a step in the wrong direction. But actually, when you look at the monthly payment, it doesn't actually make a huge difference to it.
No.
It's just when people say 3.99, it seems like the world's a bit more rosy, but it's just going up and down. And also Barclays came in the next week offering the same thing. So they're all keen to have the headline rates if they can get them, and just the fees differ a little bit. But yeah, I think certain uncertainty is a very good way of putting it, Mike.
So buy-to-let specifically, what's the appetite like early 2025 for actual buy-to-let buyers or let-to-buy buyers?
Mm-hmm. I think I've always maintained there's an appetite for people to become landlords or maintain being landlords if they can make it work, because there's obvious sort of, financial benefits of doing so. It's just, can people get their head around or swallow the tax implications or the setup costs and that kind of thing? Because, like you said, for probably the last sort of 18 months on this podcast, buy-to-let rates for the first time ever since it all started in 2022 are lower than residential for a lot of it. The headline rate for a buy-to-let at the moment, I think, is 3.39. So that's 0.6% lower than a residential. But you need about 50% deposit to get it, and the setup fees are very, very high. So again, it looks great. I think the lenders, because they do charge very high fees on those products, is why they can offer that low rate. And I think they see it as, if you've got 50% deposit and it's a buy-to-let mortgage, it's going to wash its own face. They just see it as a very, very secure.
Yeah, I mean, it's. We found stats a long time ago which suggested that repossessions on buy-to-let properties were lower than residential. Don't know whether that's still the truth or not, speaking today, but everybody expects buy-to-let to be a little bit more difficult for lenders, but they forget that if your mortgage is £1,000 and your rent's £1,500, then regardless of what's happening in your personal situation, you never handing back the keys to that kind of property.
And also a lot of those mortgages are on interest only as well.
Yeah.
So if you are experiencing a void where you've not got a tenant or just some sort of financial difficulty, the impact probably isn't quite as big as if it's your residential full repayment mortgage.
And you lose your job.
Yeah, exactly. Yeah. It's so I think that's why the lenders take a bit more of a calm approach in terms of, we can offer these lower rates because the default levels are probably lower. And also, I've said it before, but there was a big lull sort of 2022, 2023 where they just didn't lend what they used to, and mortgage companies, banks rely on lending money to make money. So even if they're not making quite the same returns as they once were, they've got to stay in business. And the two lenders that always spring to mind as the sort of market leaders in interest rates are the Mortgage Works and BM Solutions, and they just sort of almost just trade places with each other each week in terms of who's got the headline rate, and that's not changed now for about 2 years.
No, I mean, if we look back 18 months ago, we saw the buy-to-let rates with the big fees, like we've just said, where they were like, I remember seeing some at 8%, 9%. We're seeing ones now that are around 3%, and better interest rates as well. So it's banks want landlords, or lenders, sorry, want landlords in, don't they? Because they've brought the fees down and all of that sort of stuff. So there has been improvement to it. It's not all sort of doom and gloom with it.
No, not at all. It's like I said, it's definitely better than what it was. It's just still, can people swallow those if they see a 3% fee? Or it might be looking just a minute ago, I think the next best rate with the mortgage works was, say, for example, 3.89, but it still had a £4,000 setup fee.
Yeah.
So it's so much higher than residential.
I think pre-COVID, I feel like it was normal to have a 500 to 1,000 set up on a residential and 1,000 to 2,000 max if you were really struggling on a buy-to-let, which seems to have you're almost being felt like the bank's doing you a favour if it's £2,000 arrangement fee now. Having been through what we've been through, it's one of those things, isn't it? When prices go up, they very rarely come back down to what they started at. And I still feel like we're being taken advantage of a little bit by the banks in that aspect, because, like you say, there's competition to lend. So there was one point where, I don't know if it was you, argued the point, well, the arrangement fees are being lumped on to keep the affordability in track because house prices were raising so fast against rent. Putting money on the arrangement fee meant that it was the only way you could get mortgages through based on affordability calculators.
Yeah, that's a huge thing we find, and I've got a case at the moment that I'm doing where a lot of the banks will lend, and I mean significantly more, on a 5-year fixed rate than a 2-year. I've got one at the moment where it's actually a client of mine doing a let to buy, which is quite rare these days because there's tax implications on it. I remember sort of was it 2016 when they changed the tax rates? We'd do that all the time.
Yeah.
All the time.
Yeah, I did it. It was the best way. It was the best way to move. I did it. Yeah,
exactly. And I guess that's when you become a accidental landlord.
Well, accidentally on purpose. Yeah. I bought my first 2 properties. I bought with an eye on, I'll rent this out in 2 years and keep it and move on. It was my plan in the 2010s or whatever the decade was called. It was what I was going to do. I was just going to buy slightly below what I could actually afford, live there for 2 years, and then just move on and keep it and never sell a property. That went wrong, but that was my rich dad, poor dad era, and it had probably done me quite well, in fairness. But that was normal, and I don't, as an agent, I don't see it.
No, I've just got quite a unique case at the moment where, for this client, it actually makes perfect sense. He's got a lot of equity in his house, and his actual main he wants to buy chain free, but his main goal is to keep the new residential mortgage repayment much lower. He had a very specific budget, and he was going to let it out anyway. So I said, would you consider going down the let to buy route? So we can release some equity in your current property. He wants to borrow about an extra 100,000, and it will bring your monthly payment down by about £700, which they were then comfortable with. But the main challenge we're faced with that is the buy-to-let lender will only do that on a 5-year fixed rate basis, and the difference of lending between 2 and 5 is about 110 grand.
Why?
So it's huge.
It's just screaming in my head. Why? I haven't quite figured it out.
The cynical side of me just says locking people in. We've got you for 5 years, massive early repayment charge on it if you want to come out.
But I mean, if there's a big arrangement fee, so I'm minded to do it over 5 years anyway, so I don't have to pay another 3% in 2 years, because otherwise your mortgage is going to go up rather than down.
I wonder as well if, for example, that client may decide to sell that property in the next 3 years to get a refund on the additional stamp duty.
Well, do you reckon they've done the maths? They know people are going to pay them out.
Them, because it might be.
Was it 5, 4, 3, 2, 1%?
Yeah.
Kind of.
So if you're going to do that in year 2, for example, you're going to pay significantly more than if you obviously if you waited 2 years at the end of 2-year fixed rate, you've not got any repayment charge.
Yeah.
But if you did it in, say, 1 year of a 2-year fixed rate, you might pay 1% rather than 4%.
Yeah.
So that's the only reason I can really think of is that, and residential, it's crept into residential as well, is, we will, they'll lend more on 5-year. I get it with Nationwide and Halifax, they're doing these first-time buyer schemes where they'll lend a lot more to first-time buyers with a small deposit. Kind of get that in terms of the banks, what's the word I'm looking for? Security, in terms of making sure house prices don't, over a 5-year term, a bit more stability there. But yeah, for buy-to-let, Mike, I just think it's just maybe protecting against that if they're just going to redeem this mortgage.
I mean, like you say, with your let to buy man, he's going to be paying an additional 3% stamp duty on his.
It's £30,000 more.
Yeah, and the bank are thinking, well, if he sells within 3 years, we get it.
Yeah, because they're like, if he's going to redeem that, they do their maths.
They're buying windfalls.
Yeah, but also 25 years worth of interest payments potentially.
Yeah.
So if that mortgage is going to be redeemed in 2 years, 3 years, then they've got to make their money somewhere. So that's one of the reasons I can think of. But the others, it's just kind of, it is what it is. Like, if you want it, it's either the rules they put in place. It's really slowly crept in. It's just become the norm. Like you said, people just get used to stuff.
Yeah.
Just on affordability for mortgages, especially for buy-to-let landlords, what exactly do the bank's lenders look at and what they base affordability on? So obviously, if you're employed, they'll take salary into account. Do they look at investments? They look at savings as well?
It's a lot of it is these days down to what your income tax rate is. So if you're a higher tax rate payer, then the amount you can borrow is actually quite a lot less, which is why people go down the setting up a limited company route, because that's stress tested at the same rate, a lower tax rate applicant. So it might be like 125% for a limited company application, whereas a higher rate tax payer, they might want their mortgage to be 160% of the interest payment. So weirdly, it actually can be a disadvantage to be a high earner with a mortgage these days. So they're looking at that, and then obviously there's looking at what's the stress testing in terms of the percentage of the product rate versus what the monthly payment is. And again, their stress testing is significantly lower on the 5-year than it is 2, basically. So personal income only really comes into it for tax purposes, and that's how they assess it. So you could come in earning 100 grand or 30 grand. It actually doesn't particularly, they don't really care about it. They have a minimum income requirement for them of like 25,000, but it's more just, do the maths fit on the rental?
Right. Okay. I've got a few questions here from our listeners. So I want to throw these at you, Tom. Sorry to put you on the spot, but hopefully you know your stuff.
That's why you do it.
Yeah. Start mortgages. Sorry, not sorry.
Yeah.
But one of the questions was, are fixed or tracker mortgages the smarter options for landlords in 2025?
Short answer is fixed, because you just know, you can do the maths on your investment. You know exactly what your payment's going to be. And again, I don't know this for sure, but I imagine this is the case. I just see fewer tracker options when doing sourcing on buy-to-lets, and I think the lenders just don't offer quite as many because they just see that a little bit of uncertainty with what's going on with, because that's obviously going to be directly linked to the Bank of England base rate. And if things start changing and that goes up again, I just think the banks get a little bit weary on their kind of affordability assessment. So I think they actually like to push people down the fixed route anyway.
What's your outlook on the base rate coming down? So obviously we had a little drop on it. I think for the next one, from all of the stuff that we read, it might stay the same. As in, many people thought it might come down again. I mean, some people thought that there'd be sort of three changes this year and it reducing, but things are having an effect on that where it may stay the same for a longer period than what people thought. Does it really have a massive effect on mortgages? Because we saw it come down, and then we saw the interest rates go up on mortgages slightly.
So no, for the only rates that they directly affect are tracker rates, because it'll be in a stipulation somewhere that if you've got a tracker rate, it has to track something, and it's normally the Bank of England base rate. So the banks build that into their sort of calculations. But yeah, the fixed rates, for that, you just want to be looking at swap rates really, in terms of knowing what slightly go ahead. So for example, 5-year swap rates at the moment are just below 4%. which gives you a kind of a good idea where fixed rates will go, but that has no bearing on tracker rates whatsoever.
Okay, next question. What's the biggest mistake landlords make when securing a buy-to-let mortgage?
Ooh.
Have I put you on the spot with
Possibly.
I reckon you've already answered it in when they take a 5-year mortgage, but with a huge redemption penalty, is you've got to plan your mortgage based on planning your buy to let. How long are you going to hold this for?
Yeah.
Rather than just choose the cheapest rate.
Yeah, that could be a mistake, but it's also the landlord had no choice in the matter to make the numbers work. So it's almost like a mistake that they're kind of having to make, if it makes sense. I would probably just say that look at the simple answer is probably just don't rate chase the lowest rate, because you'll see a headline rate on compare the market or whatever, and then in very small writing, oh, by the way, brackets 3 or 4% fee, and then that's when you really speak to a mortgage broker who's got a slightly different type of calculator who can take into account all the different fees for total amount payable over the product term. And we can do the maths and work out what it's like, because quite often, and it's the same in residential as well, you see a sucker headline rate, but the fee just does not add up. So actually, let's go for a slightly higher rate with a fixed fee of say 1,500 or £2,000, and that actually over the 2 or 5 year period is actually the better economic decision to make. So that's probably the biggest one is don't just chase the lowest rates, I would say.
Okay, last one. Are there any overlooked mortgage products or strategies that could save landlords thousands?
Not landlords that I know of, to be honest with you, just being totally honest there. There's, again, on the residential side, I sent out some information on joint borrower sole proprietor mortgages, which are basically the old guarantor mortgages. I've been a mortgage broker for 13 years. I've never done a guarantor mortgage. They've always been joint borrower sole proprietor mortgages, which is basically where 2 people are on the mortgage, but only 1 person is on the title deeds for the property. So it saves additional stamp duty if mum or dad, who's already got a property, wants to come on and help. And that's a product that I tell people about and they've never heard of it, but that is much more a residential thing than buy to let.
I've got a good one for a good tip to save people thousands is just when your mortgage broker sends out the paperwork and the direct debit gets set up at £1,213 a month, is just round your direct debit up to £1,300 and then go on one of the little overpayment calculators and see how much money you'll save over 20 years. It is genuinely mind-blowing. The compounding way it works, that if you overpay by like a random number like £77 a month, you will save yourself a mortgage payment a year, and then it gets better in the first year, and then it gets better and better and better and better because you've already paid. You're not paying interest on your interest, and you'll owe that £77 that you would have never really noticed anyway. I don't really sound blasé about £77, but it's like once you're set up and you're used to paying it, you'll save yourself like thousands over the term.
There's a guy I really like called Scott Galloway who does a lot of this around just compound interest for savings, and the numbers he throws out, I'm like, that cannot be right. And then he explains it so well in like layman's terms as to if you can just be disciplined and never touch it for 15 years or whatever, this is what it will be at pretty low interest rates. That's exactly the same reverse with mortgages. If you can just be discipline that overpay by £50, £100 and keep doing it, you will save thousands because you're getting it paid off so much quicker. And like I said, we've got calculators. If anyone listening wants it, we can send it out. A lot of lenders have their own on their websites. You can just play with it and just be like, if I overpay by X amount over this amount of years, it literally just shows you
how many years do I save, or how many thousands of pounds do I save. And
that pays for a lot of holidays or whatever, when you put it in
tax bills.
Tax bills, council fees.
So just going back to sort of landlords and current market, what are you still seeing a lot of inquiries coming through from landlords? Because I mean, what I'm seeing at the moment is people have created this negative sort of market update image that landlords are exiting in their hundreds of thousands. The rental market's dead. There's no money to be made in it now. But from what we can see sort of more rental properties coming into the market. Demand might have decreased slightly, but these hundreds and thousands of landlords exiting doesn't seem to be the case. So to me, there's still money in it. There's still a demand for rental property. And I think the importance of what landlords are looking at now is, all right, margins might be smaller than what they've got, but how can I sort of refinance that in a way where I could benefit more? And rental prices will be increasing. That's just going to happen. People that are saying that rental prices are going to go down or inflation rates are going to go down, it's just nonsense, because from what the outlook is that you can see that it might be an inflation rate of 4 or 5% or something like that this year. So there's good money still to be made in there. But I think what landlords are guilty of doing is not looking at the refinancing side of things. So what is there a particular thing to do for landlords out there to structure their refinancing, or is it just best to speak to a mortgage broker? You've got certain products or something like that can look at. Are there any products out there at the moment that benefit landlords with more energy efficient properties?
The lenders definitely much or offering a lot better rates on, say, A or B EPC rating properties. They quite often give like cashback options and that sort of thing, or have a much lower setup. And cashback can be quite significant for like £1,000, that sort of thing. But going back to your original question, Andy, I'll say my existing clients who I've dealt with for years who are landlords, I don't see any of them wanting to get rid of their portfolio, their properties, because I think there's still an appetite to be a landlord for a lot of people. And property, just over the course of time, is a good investment. And if you've got an extra property in your portfolio, likelihood is it's probably going to go up in value at some, over the course of 25-year term. For a lot of people, it's thinking about, if my pension pot is looking a little bit smaller than I like it to, then the buy-to-let property is a great way of helping with that. So I certainly don't see loads of people thinking, I'm just going to get rid of my buy-to-let properties. That's just my experience. And I just do think that, I just really do think if there's some tweaks to taxation around it, you'd see so many more people actually going ahead and becoming a first-time landlord. Because for me, certainly the appetite would be there. I'm moving property at the moment. I would love to let out my existing property. It's only a one-bed leasehold flat in Crowthorne, but I know what my neighbour, for example, pays rent on it, and there's a very, very good yield on that. And I would 100% just let that out and buy a new property if the stamp duty didn't, unfortunately for me, make that decision not one I can go for. So, yeah, I don't see the negativity personally.
Outlook for the rest of this year, Tom. We like doing predictions on this. Mike's now.
It's because you can come back and be really smug.
Yeah, so you said 6 months ago.
Yeah. Mike's done a couple of predictions before, and they've actually come true.
I'll try.
It's like Mystic Mike. But what do you think that's going to happen from now till the end of the year? Are we going to see better interest rates? Are we going to see more lenders lending?
I'm probably going to give you a really boring answer. I don't think it'll be a hell of a lot different to what we've got now, which I know is not what you want to hear.
Offense.
No, but I think what we will see is a lot more lenders. Again, this whole sub 4% thing has become a little bit the same, but I do get it. It's kind of because we went for so long where it was just 4.5% was like a really, really good rate. And I literally just did a remortgage for a client the other day where for the first time in ages, I'm saving someone money, because I used to do it all the time. It was like, your remortgage is up. It's really competitive to switch. I can probably save you £100 a month. And people were so blasé about that. Now I've got a guy who was on 6.1% 2 years ago. I can now get him 4.7, and he's once again saving money. So there's a bit of a feel-good factor there. But yeah, I think we'll see more and more lenders getting into that sub 4% bit just to get a bit of market share. And again, if it's a bit of a domino effect, once one or two start going, and then you've got, you say, like Barclays and Santander, who are the main leaders of it, but you see Halifax, for example, they don't want to be like stuck being seen as the expensive lender for that week, because it is very, very competitive. So I do think the more we see them dipping sub 4, more lenders will follow suit with it, because they want a bit of that. So I don't think there'll be anything drastically changing, in my opinion, but I think we'll see more and more just creeping. It's definitely creeping down in the right direction for people, which is good.
Nice.
I've got a last question. We might just sneak in. Protection. If you were going to protect your residential or your buy-to-let, in a word, do you protect your residential or your buy-to-let?
Residential.
Interesting. That's the end of the episode. We've been waved at. We've been waved at through the window. So that's the end of the episode. If you've got any questions for Tom, feel free to DM us, pass it on. We'll pop his details as ever in the show notes, and we'll catch you next week.
Cool. Thank you.